Hi, happy Monday. In today's video, I want to go over more in the depth of debt to income ratio when you're applying a home loan. Let's get started. So I Googled the most trending and rising question that most of home buyers and they're having is, what is the debt to income ratio, and what percentage is good for in terms of applying for mortgage? What is acceptable, or how low that should be, or what is maximum? So I want to go over that, and then how is the debt to income ratio impact your home loan? So what is debt to income ratio? So basically, that is your monthly gross income versus your monthly liability or your monthly debts, the bills that you need to pay out. When we talk about in mortgage, we do not use your health insurance or your groceries, your light bill to calculate into your debt to income ratio when you're applying for home loan. We only use things like student loan, personal loan, auto loan like a car, boat, and a credit card or credit cards if you have more than one. And then if you are leasing a car, yes, that would be, I'm assuming that you would have either lease a car or buying a car you financed. So then if you have any type of personal loan or federal loan, and if you have a child support and alimony, if you make $40 per hour, you work 40 hours per week, and you are hourly rate paid employee, then I just use the $40 per hour times 40 hours per week, then times to 52 weeks. I know a year is 52 weeks. Then that will give us a year income. Then divided by 12, you're probably making around $6,900 per month. That is based on $40 per hour, 40 hours per week, and 52 weeks per year. Then that's your monthly income. But we will look at your pay stubs and your pay stubs, W-2s, and last 2 years returns. Let's just say you have about $2,000. No, just say $1,500 debts. That's including your car payments, your credit cards, and your just a student loan. So for now, you have a $1,500 debts, and then you have $6,900 income. So you use your monthly debts, divided by your gross income. That gives you a number, turns into percentage. So you're now at 21.739%. Let's use let's use the whole number, so about 22%. So that is before I add housing payment. Okay, so just say your housing payment is $1,800. So you have $1,500 debts plus your $1,800 mortgage payments, the PITI, which is included principal, interest, tax, and insurance. Let's just say it's $1,800. So we got 15 plus 18, that's $3,300. Then that is a housing and including your debts. So we call in mortgage world, we call back end ratio. That is the one we use. Really look at your maximum ratio. So $3,300 divided by 69, you make a little bit more than 69. Let's say 3,300 divided by 69, 33 equals 48%. It's 47.5. That's give you whole number is 48%. In that case, I know you are on the borderline of conventional loan, because we want you to be in within 36% for conventional loan, but actually in the real world, I can prove you for as long as you're below 49% for conventional loan. But the problem is, if anything changes, this number going to change. If I qualify you $300,000 house on monthly payment for PITI is $1,800, your ratio already at 48. That is the maximum that I can do. Then if anything changes, for instance, you find a house, when I qualified you, the property tax is $300 per month. But now you the new property that you fund, the second property, not new, the second property you fund that is $400 per month for property tax. So you increase $100. So used to your $1,800 is total your monthly payment. Now it's $100 more. So they became $1,900 your debts. So you use that divided by 6933, your gross monthly income. No, 34. Yeah, 100 divided by. So that is 49%. That's what I'm saying. Sometimes if your DTI ratio is a max out, you're at a max, so any changes could negatively impact your loan unless you have additional cash to put more down. So for FHA loan I have a little bit more room. So the conventional loan, I figured I want you to stay below 49%, 48%. I prefer you below 45. So give you more room, and as long as looking property wise, if anything your property tax changed or insurance changed, you have more room to play with it. But if you hit at maximum, then you really could maybe you have a hard time to get approved. So for FHA loan, I try to say let's do below 55%, and yeah, so that's on the two type of loans. And then let's talk about DTI ratio. Then how is it impact your loan? Because credit score is a thing to help you get into the door. Then after that, we check everything else. The DTI ratio is really determines you as long as for your loan approval wise. Either you get approved or denied, or could lower your price range. For instance, then maybe I'm not able to approve you for $400,000, but maybe I could approve you for $350,000, or you could put a down payment, more down payment that I could do too. When you have a better DTI, lower DTI, so it just shows you lender that you invest in you is low risk to us, and you know how to manage your bill, and I hope you're not going to default on the loan. So that is how do you calculate the DTI and what is involved, why is important. I went over that. So leave a comment if you have additional questions, and let me know. And I already made a video about closing disclosure, loan estimate, but maybe I will remake that, go a little bit more detailed, maybe in that way, so you can understand more and learn more about it. So let me know what kind of topics that you are interested in terms of mortgage and real estate. So thank you for watching. Subscribe and follow me, and thank you so much.